I now hand the conference over to Mr. Pinku Papan, Head of Investor Relations at L&T Technology Services. Thank you, and over to you, Pinku.
Hello everyone, and welcome to the first quarter FY22 earnings conference call of LTTS. I am Pinku, heading Investor Relations. To those of you who have joined from India, thank you for participating at this late hour. We apologize for having to hold the call at this time. Our financial results, investor release, and press release have been filed on the stock exchanges and are also available on our website www.ltts.com. I hope you have had a chance to go through them. This call is for 60 minutes. We will try to wrap the management remarks in 20 minutes and then open up for Q&A. The audio recording of this call will be available on our website approximately 1 hour after this call ends. Let me now introduce the leadership team present on this call, and we have Amit Chandra, CEO, Abhishek, COO, Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. Let me now turn the call over to Amit.
Perfect. Pinku, you can hear me fine?
Yes, go ahead, Amit.
Perfect. Thank you, Pinku, and thank you all for joining us today. Again, apologize for the late call India time. I hope all of you are safe and healthy. I'm happy about our strong Q1 performance that was in spite of the challenges we faced on account of the second wave. I would like to first start by thanking our employees for their resilience, their commitment, and the teamwork, and then our customers for standing by us during these extremely tough times. We've rolled out multiple measures to support our employees, and our focus is now on getting our employees vaccinated as soon as possible to be able to get back to some degree of normalcy. Let me now go on and talk about our quarter one performance. In USD terms, we had a sequential revenue growth of 4.2% Q1Q and crossed the 800 million run rate on an annualized basis. If you remember, we came very close to this milestone pre-COVID, so it is definitely very gratifying and satisfying to get past this. Growth was broad-based with 4 of our 5 segments growing in the range of 4 to 8%, led by industrial products. The Ebit margin of 17.3% despite wage hikes reflects the gradual portfolio shift towards more digital engineering as well as operational efficiencies around hiring of freshers, cross-skilling, productivity improvements, and cost optimization. Our large deal pipeline and conversions remains healthy in Q1. We won 11 deals across all segments, out of which 6 deals were 10 million plus. 2 of these were actually 25 million plus TCV. Before I discuss the segments, I would like to highlight our strategy to build scale in core new technology areas, which was first presented in FY21 annual report that got published earlier last month. As part of this strategy, we have identified 6 strategic investment areas: electric autonomous connected vehicles, 5G, medtech, digital manufacturing, AI ML driven smart products, and sustainability. These 6 areas we believe we will be able to build a sustainable growth engine aiming at building innovative concepts and solutions that can help our customers build next generation products and offerings and reduce time to market. We will keep our investors and other stakeholders engaged on the progress on this as we move forward. Let me now provide a segmental performance outlook to you. Starting with transportation, we had a sequential growth of 4.3% led by strong demand in electrification, led programs and platform development across both auto, trucks and off-highway. In the US, you would have read about the infrastructure spending plan, which seeks to accelerate the transition towards electric by investing in a nationwide charging network. There are similar goals set in Europe. This sets a very clear direction for OEMs and Tier 1s to invest in new technology areas and EV production capacity. EACV, or Electric Autonomous Connected Vehicles, is one of the 6 technology focus areas for us. Our EV lab that we had invested in last year, plus solutions that we are building like e-powertrain, onboard, offboard, energy management, connected cars will help us go forward. In Q1, we won 2 25 million plus deals in auto, both in the EV space, one with a new age OEM and one with a major Tier 1. The scope of work with the new age OEM covers the entire value chain, including vehicle design, while the Tier 1, we are providing software and system design in their power electronics portfolio. We believe such early wins in new technology will help deepen our strategic partnership with our customers. In aerospace, we are seeing the commercial segment slowly coming back. Airline manufacturers and operators are spending more on digital transformation and connected platforms. Overall, for transportation, we are optimistic about the growth momentum continuing across all three segments. In plant engineering, we had another strong quarter with 4% Q-on-Q growth, with growth being driven by FMCG, followed by oil and gas and chemicals. In FMCG, customers are leveraging our expertise as they open new plants. Recently, we won an order from a food giant to design a plant to meet the most stringent global food and beverage standards. We are also deepening our expertise on the sustainability side, with one more win on the wastewater treatment area. Sustainability is one of our 6 bets or strategic investment focus areas where we are investing, and we expect a lot of spending to happen in the future. In oil and gas and chemicals, as strategic partners to our customers, we are working with them across the globe in brownfield expansion, asset digitization. CapEx spend outlook is improving with oil prices going up, and few oil and gas majors are having discussions around product mix optimization as well as quicker transition to green fuels. Summing up, for plant engineering, we continue to see a good set of opportunity that will...
Sorry to interrupt you.
We had a strong quarter with almost 8%.
Hello, Mr. Amit, can you hear us? Hello.
For industrial products, we had a strong quarter with 8%, almost 8% quarter-on-quarter growth, with all three sub-segments showing good growth, electrical, machinery, and building automation. While industrial products was hit.
Hello, Mr. Amit, can you hear us?
Expect it to grow faster than company as we move forward. The large account focus with continued demand for product digitization and personalization, shop floor automation and digital twin has been driving this growth. The pickup in industrial capex and manufacturing activity across US and Europe should aid the momentum in this segment. We are seeing a good pipeline and opportunities in industrial products and expect the growth traction to continue. Moving on to telecom and high-tech, the growth rate bounced back in Q1 to 4%, driven by semi, consumer electronics and telecom. In semi, there is a strong demand for chip design services for end industries like automotive, consumer electronics, data centers and telecom. Our recent win in providing labs as a service and co-investment into new labs and technologies along with customers will help us drive growth as we move along. In telecom, there are huge investments being made in 5G, leveraging open brand technologies, both in traditional telecom as well as infra OEMs, as well as some of the ISVs. We recently announced a partnership with Navinair, a leading 5G player in network automation. We believe such partnerships are key to building the software that will run on next generation telecom gear. Overall, the deal win momentum has provided telecom high-tech. We won 2 10 million plus deals in Q1, gives us confidence of sustained growth as we move forward. Finally, medical. In line with our Q4 commentary, we had a soft quarter in medical, but we see the outlook improving for diagnostic devices with the rising vaccine penetration in US and Europe. Demand for digital products, platforms and optimization of manufacturing processes are key growth drivers in the segment. MedTech is another area of focus for us. We have deep domain knowledge, have built reusable assets and believe that will help us with the work being done in AI-based diagnostics, decision making and infection management platforms. We expect growth traction to see a jump from Q2 onwards as the deal traction improves. Now for a few highlights on digital engineering and technology. Our digital engineering revenues were 54% in Q1 versus 52% in Q4. We see this trend continuing. On the innovation front, our engineers continue to innovate and file 23 patents in Q1. This is a record high. We are committed to increasing our talent pool in digital engineering skill, and our Global Engineering Academy, which was established last year, will continue to work to ensure that we are able to get the right talent as we move forward. Let me go on to discuss the outlook. From a geography standpoint, we see a strong demand outlook in both US and Europe, while in Japan and India, decision-making environment is slowly recovering. We are confident that the growth will continue to be broad-based. With better line of sight for FY22, we raise our USD revenue guidance to 15 to 17% for FY22. I would like to make one more important announcement before I end. We are planning an investor day in September and look forward to your participation. We hope to provide more color on our new strategy in the 6 investment areas during the event. Pinku will be communicating the details to you shortly. Let me end by wishing all of you the best of health and safe passage. I now hand over to Rajiv. Thank you so much.
Thank you, Amit. Greetings to all of you. I hope that you and your families are keeping safe and healthy. I'm glad to share a strong Q1 performance with healthy improvement across revenue, Ebit margin, and PAT. Let me walk you through our Q1FY22 financials, starting with the P&L. Our revenue for the quarter was 1,518 crores, a growth of 5.4% on sequential basis. As you would have observed, we are back on double-digit year-on-year growth, with Q1 revenue up 17% year-on-year. Also, Ebit margin crossed 17% in Q1, making it the 4th consecutive quarter of operating margin improvement. The 70 basis point sequential improvement in Ebit margin to 17.3% was driven by portfolio shift towards digital engineering, operational efficiency measures including productivity improvement and cost optimization, and rupee depreciation that together helped fully absorb wage hike, higher subcontracting and third-party contracting expenses. Moving to below Ebit, other income was slightly higher on sequential basis due to higher treasury income and forex gain. We did not accrue any export incentive income, and this will be the case going forward until we get further clarity from the government. We continue to follow up with the authorities to expedite claims for FY20. Our estimated tax rate for Q1 was 26.6%. We are moving to the new tax regime from FY22 onwards and expect the full year ETR to be between 26.5 and 27%. Net income for the quarter stood at 216 crores, which is up 14.2% of revenue, up 11% on sequential basis, driven by higher revenue and operating margin. Moving to balance sheet, let me highlight the key line items. DSO was 85 days at the end of Q1 compared to 75 days in Q4, while unbilled days was 27 days in Q4 compared to 17 in Q4. The combined DSO including unbilled stood at 112 days, which is above our target range of less than 95. This is because we embarked on the first phase of system transformation in Q1, which is a precursor to a full rollout later this year. This resulted in delayed invoicing. Let me talk about cash flows. As a result of the increase in DSO, the free cash flow dropped to 69 crores in Q1. We believe this is temporary and we will see normalcy return in the coming quarters. Our cash and investments rose to 1,777 crores end of Q1 FY22. Moving to revenue metrics, the dollar revenue growth was 4.2% sequentially in Q1, with 4 out of 5 segments growing sequentially as highlighted by Amit. Growth was led by industrial products. The segmental margin performance was better across all 5 segments on a sequential basis, with transportation and plant engineering showing marked improvement. Transportation segment has improved to 19.3% EBITDA, resulting from growth in revenue and focused measures undertaken. Now let me comment on operational metrics. Utilization improved slightly to 79.2%, and so was the case in on-site offshore mix, increasing marginally to 58.1%. The time and material revenue mix increased to 66% in Q1. This metric has been in 60 to 65% range in the past few quarters. Moving to client profile, which is the number of $1 million plus accounts, showed a sequential improvement in the 20 million plus category and the 5 million plus category, while others are flat. Like we highlighted in the past, this is on last 12-month basis. Q1FY21 quarter was a challenging quarter and is not anymore in the mix. Hence, we will see this metric improve going forward, reflecting the growth in top line. Client contribution to revenue, here again, this is on LTM basis, and we can see the improvement across all the three buckets, top 5, top 10, and top 20. Headcount increased by 520 sequentially, while attrition moved up to 14.5%, which is at levels below what we've operated in the past. However, we are proactively taking various employee engagement measures to contain attrition. Realized rupee for Q1 was around 73.8 to the dollar, a depreciation of 1% versus Q4. Before I end, let me give some color on Ebit margin trajectory we see going forward. In Q2, we will have the headwind of residual wage hike as we roll out salary hike for mid to senior level employees. We aim to offset this impact through improvement in combination of operational levers like employee pyramid and productivity. Rising attrition, which is an industry-wide trend, is another headwind that we'll have to keep a close watch and are taking several measures to contain it. Growth and quality of revenue is the major lever that has and will continue to aid margin improvement. Further, we continue to work towards improving margin in telecom and high-tech while pushing for better growth in higher margin segments like medical, industrial products, plant engineering, and transportation. Overall, while we do not provide a guidance on margin, the effort will be towards sustaining the progress made so far and strengthening the operating model. With that, I now pass it on to the moderators to open it up for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Please note, all participants are restricted to ask 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Elroy Lobo from Kotak Investment Advisors. Please go ahead. Elroy Lobo, may I request you to unmute your line from your side and go ahead with the question?
Yeah. Can you hear me now?
Yes, sir, we can. Thank you.
Yeah. Congratulations on the good set of results. I have about 3 questions. The first one is on your client profile. You have about 5 $20 million clients, about 20 $10 million clients. I just wanted to know, what is the potential to which you can mine this client? Can they be $50 million accounts, $75 million accounts, or do they get capped at around $30-35 million? So that's my first question. The second question has to relate with your progress on the ISP business and the telecom business. If you can just give us some update on what progress you have made to build capabilities, more capabilities in these 2 spaces. And just wanted to also check with you as far as going forward in terms of the growth trajectory. Are you seeing increased spending and more of the captive business coming into the outsourcing market in the ER&D space? Would you comment on that? Thank you.
Sure. So, thank you so much. You can hear me fine?
Yes.
Is it audible?
Yes.
Okay. So, Okay, perfect. So number one, in terms of client profile as you see it, right, we definitely feel that we can actually, it's normal in our business to actually have clients that are more than 50 million as well, right? So you're not capping off at 30 to 50. In fact, I go back 3 years and we used to have a couple of clients in that range, right? So having said that, there is a clear mining focus in the company, account mining. There is a hunting focus in the company, and we continue to work on this. The reason the metrics in Q1 do not look up to you right now is because we use trailing 12 months of revenue to be able to report the client range. But as we move forward and the FY21 metrics gets, revenue gets fleshed out and the new revenue comes in as you see it, you will see the client pyramid improving. This is a core focus area for the company and will continue to be one as we move forward. In fact, we had talked about a T30 A3 strategy. That has not gone away. That continues to be the case as we move forward. Your second question was on capability building in high-tech and ISV. So as far as we are concerned, high-tech for us is actually 6 sub-segments. There is semiconductor, there is telecom infra, there is telecom operators and communication media, there is consumer electronics, there is ISV, right? So those are the segments broadly that or sub-segments we operate in. 5G is one of those areas which will cut across a lot of these sub-segments and is a clear attention and focus area for us as we move forward, including the company that we bought last year and the Semcon building capabilities we have got through acquisition, VLSI design capabilities that we have got in-house as well. Having said that, on the ISV side, software capability continues to be something that we are building on, be it cloud product cloud, be it cybersecurity, be it DevOps, SecOps, be it UI, UX, etc. So these are capabilities that continue to be built out in the company. And as we move forward, you will continue to see progress in these areas. We are also actually taken ISV and actually broken it up into focus on medical, focus on industrial, etc. So there are use cases that we have built out in the software side to take to the market, and we are fairly comfortable and confident that you will see growth here. Can you repeat your third question?
Yeah, the third question was to do with the outsourcing in ER&D. Are you seeing an increase from the captives, or is it stable? What's the trend you're seeing there? And if I can just also chip in another question. Mindtree recently acquired the next digital business from Larsen & Toubro. I would have thought that this made better sense for LTTS. So if you can comment, how are these acquisitions being made at the group level? How do you connect with the group to make sure that some of this actually come into your plate rather than going to one of the other group companies?
Sure. So let me address the growth part. So as we look at it, and these are numbers that are publicly available, the ER&D space today is about $1.4 trillion as of 2020 spend, right? Of this $1.4 trillion, it is supposed to grow to anything between $1.75 to $1.95 trillion by 2023, right? Now, out of this 1.4, that's of CY20, $80 billion is outsourced to engineering service providers, and India gets 16 billion of that $80 billion. Global competency centers or captive centers is about $50 billion of spend, out of which similar $16-18 billion comes to India, but there is an equal amount going to China, and then there is Latin America, etc., etc. As we see going forward, we do expect ER&D spends to grow. We do expect outsourcing to engineering service providers like ourselves and others in India Inc. as well as Western Europe, Eastern Europe to grow. We also expect global competency centers to pick up. Having said that, you may see some more global competency center spend going to Eastern Europe and LATAM, and China slowing down from a global competency center standpoint. So that's broadly the contours that we are seeing it today. And if there's interest, there's further details that we can get into, but broadly that's where it is. If I go on to L&T Next being bought over by Mindtree, so L&T Next has some very targeted products, reusable widgets that they have built in the areas of digital for construction companies, which is being used by L&T. And the group thought that Mindtree acquiring it was the right answer. Having said that, I cannot comment on that being right or wrong. All I can say is we have a clear strategy in the 6 investment areas that I have outlined for you, and we do believe that that growth will stand us in good stead, sustainably, profitably as we move forward. Thank you.
Thank you very much. I request all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next question is from the line of Sandeep Agarwal from Edelweiss Financial Service. Please go ahead.
Yeah, good evening and congrats on a very good execution and very good quarter. I hope and wish everyone safe health. So I have only one question, Amit. We are in a situation where, the demand from the consumer side is at very high. Factories have not worked to their optimum level, so there's a big gap between demand and supply across the globe on the consumer side. The outsourcing of the ER&D has to go up tremendously because ER&D has not gone through the outsourcing which the software industry has gone through. On top of that, there is severe scarcity of manpower in whole of Europe, and and if you add to that our market leadership, our capability in each of these areas, and also the world's urgency and desperation to upgrade the feature products into smart products. If you take all these 5 things together, and even if you apply a very, very pessimistic approach to that, then also it looks like you are getting into a golden decade of growth in your business. So why that kind of confidence is not reflecting in our commentary? Is it because we are not so sure about any third wave or fourth wave impact which can happen because of COVID? Or it is because that you are still finalizing your strategy and you would be more opening up or would be giving more clarity going forward? Because no way I am able to reconcile this, that when there's such 5 huge tailwind, I have not thought of this kind of tailwind. I don't think such huge tailwind has ever come together in last 20, 30 years. Then why our commentary is not reflecting that same optimism? Thank you.
So Sanjeev, 2 things here so that we can level up and be clear. Number one, I share your optimism around demand, your optimism around the 5 vectors that you talked about. Having said that, Sanjeev, you will agree with me that there is only a certain amount any company spends in any given year, right? That's one. Second is that given that, if you look at the 6 strategic investment areas I talked about, and during our investor day we'll share more color, these are not quarter bets. These are bets that are made for the next 3 years, 5 years. And that's what we have done, that we have taken all these 5 tailwinds that you talked about, and there are tailwinds per sector, right? And we have created this investment roadmap for ourselves in 6 areas, which we believe will give us a sustainable trajectory as we go forward. So we are taking that into account. Having said that, let me then focus only on the year. On the year so far, we've already upgraded our guidance to 15 to 17%. We will come back and update you as we move forward into next quarter on where we stand, and we'll continue to be honest, direct and transparent with you because we really treasure our relationship with this community. So that's where we are at this stage, but we mirror your sentiment in terms of tailwinds, and we'll continue to provide an update to you.
Thank you. The next question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks. Amit, first, just wanted to, get a bit of an understanding on the Q1 performance. It clearly looks like, it was better than what you initially expected, especially the COVID supply impact. So, can you just highlight whether it was supply or demand which materially moved the performance this quarter, and how do you see it play out, currently as you enter Q2?
Okay. So number one, when we met last time in May, we met under the shadow of a wave 2 that was rearing its head up, right? If you remember to that. And that played on our minds as to where we are. I do want to acknowledge that we've also had fatalities like everybody else in our workforce. We've had workforce that has been infected. And like I said at the beginning of my commentary, things have gone through very harrowing times for our employees and their families, right? And I'm sure you'll understand that. So we took that into account when we had given you commentary last time. At this stage where we stand today, we are fairly comfortable with the fact that wave 2 is done. We hope and wish that wave 3 will not be as bad because vaccinations are going up, right? We are actually getting our employees vaccinated, their families vaccinated, etc. Demand is there. So, in fact, if anything, demand has slightly improved, spend has slightly improved. And as I said, this is a progressive quarter. Let's go through it. I have also acknowledged to some of you in parts as well as to the whole team on this call that our internal targets are there, that we continue to try and achieve to and aspire to. We haven't forgotten years where we have grown higher in past years, and our aspirations will be the same. But again, at this stage, this is where we are, and that's what we wanted to communicate to you.
Sure. On the demand side, you mentioned demand environment is good. We heard recently from ISG also that deal sizes in the R&D space are increasing. But at the same time, we are also hearing about increased competition with Accenture highlighting it as as a focus area. So both from deal size perspective and competitive perspective, is there any change which you have seen in last quarter, last 2 to 3 quarters, or things remain the same?
So number one would be definitely seeing is that clients are willing to talk and commit to larger spends and longer spend cycle spend. So like TCV of 3 years, they're willing to sign a document, right? About 4 months, 6 months ago, there was a little bit of trepidation, they didn't want to do that, etc. So we're seeing a lot more confidence back in the market in terms of making commitments. Number 2, longer term commitments, bigger commitments. So that's definitely one that we're seeing. That's how we won the 2 deals in EV, etc., onwards, right? Second, we are looking at clients making strategic decisions in terms of, so I want to be able to get to 5G rollout in subsector A, use case A and B, etc. Or I want to get to electric vehicle. Electric vehicle, I've broken it down. I will first do the power distribution unit. I'll next get to higher end wiring. I'll then get to inverter design, etc. So there are clear phases people are drawing out as if this is a multi-quarter or multi-year thing rather than sprints, right? Which is very heartening because you're having a longer term conversation that provides more strategic direction and more warm and fuzzy with clients. In fact, happy to share, I've completed my first set of face-to-face meetings in the last 4 weeks, and so have some of my leaders in the geographies where we operate out of. So stuff is coming back, and that provides us that confidence. The third thing we are seeing is specific areas that have picked up interest and pace, like electric vehicles has picked up pace, 5G has picked up pace, sustainability has picked up pace, changing the composition of fuel, right, to higher mix, higher value mix has picked up pace. So that gives us a lot of confidence as we move forward. And this was not the case, if I may be very clear, this was not the case 5 months ago, 4 months ago.
Thank you very much. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on very good execution, both on revenue and margins. Just on margins, one of the tailwinds which we have witnessed, which we have said that the portfolio mix has been shifted more towards digital engineering as a whole. So on a Q1Q basis, yes, it has gone up by 200 basis points, but we never called out this as a tailwind on margin earlier quarters. So is it the pricing which is going up on a digital engineering, or is it the margins within the digital engineering are now different in first quarter versus what it used to be earlier? And will it be a sustainable structural tailwind going forward?
So it's not just, and I'll request Rajiv Abhi to add from Mumbai here, but it's not just one factor, it's a multiple factors that have played to this. Rajiv Abhi, would you like to add to this?
Sure, Amit, let me add to it. So there are various factors that have led to the improvement in margin, right? One is, of course, the growth and the quality of revenue. Things like digital engineering and the increase that you talk about, I mean, these are things that take a little time to play out. More importantly, it's the quality of revenue that is beginning to now aid margin. And in terms of, the sustainability, we still feel that there are opportunities. For instance, growth and scale of revenue will bring in economies across cost, right? And that's around sales, communication, legal, all of those costs. Segmental margins, we talked about it earlier as well. We've got opportunities in two segments, transportation and telecom and high-tech. Transportation, we've already now seen EBITDA margins go up to 19% plus range. Telecom, high-tech, it is taking us a few quarters. We are focusing and working towards it. We should hopefully be able to see better margins in telecom and high-tech in the next few quarters. Further opportunities also in terms of improving employee pyramid. We've started to hire a lot more freshers over the last 2 quarters, and we believe this strategy will help us in building the employee pyramid and also in a way try to bring down the C&B cost as a percentage of revenue. These are some of the factors that we feel will help us in terms of sustaining the margins going forward as well.
Okay. And just a follow-up question. Are you trying to say that in the coming quarter, we will be able to sustain the current quarter margin, or we may further improve it rather than any decline despite a partial wage hike which is pending? That is what we are guiding from Q2 to Q4?
So, I called out the various factors and, of course, the levers that are available in terms of sustaining margin. Of course, when you look at various factors, we still need to see the performance in terms of revenue. Amit talked about the improvement in terms of guidance from 13 to 15, raising it to 15 to 17. So some of these we still need to see in terms of the execution. Like I said in my opening commentary, we continue to remain focused and we will see how best to sustain the margins that have been delivered in Q1.
Thank you. The next question is from the line of Hiten Jain from Invesco. Please go ahead.
Yeah, hi. I have 2 questions. First is, I think you touched upon in the opening remarks, but maybe you can clarify it more on the receivable days going up and even especially the unbilled part. What is leading to that?
So I'll take this. So we went through a system transformation program in Q1. We've kicked off the first phase that led to delayed invoicing. We believe this is temporary. As you would have noticed, all of last year we improved DSO and consequently we improved free cash flow. Q1, of course, is a temporary, I would say, situation. We will improve this in the coming quarters. The system transformation should conclude over a quarter or so. So Q1 is only a temporary position, so to speak.
Okay, understood. And the second question is on the headcount growth. So we operating at a higher utilization level. We're seeing good demand, in terms of commentary and potential deal wins. But headcount growth seems to be muted, even sequentially and obviously on year-on-year basis. So what are our hiring plans going forward?
So now, we don't normally comment on exact headcount addition, but what we will definitely tell you is that as you can see, the headcount has gone up by approximately 700 people. Right? This was partly freshers, partly laterals. Going forward, the plan of the company is to continue to hire about 400 to 450 freshers plus laterals every quarter. Now, of course, there will be attrition, there will be exit, so you will continue to see net increase, but we don't provide guidance on exact number headcount increase quarter on quarter. Rajiv, Abhi, if you want to add to this, you can, please.
No, I think that's clear, Amit.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good evening. On the transportation side of the business, the margins there seem to be at the higher end of what they have done historically. Just wanted your thoughts in terms of what's changed within the transportation mix that's actually driving this margin up. Is it a mix in terms of the kind of business that we're doing, or is it that, or what exactly is basically driving this margin up, and how sustainable is it? Any qualitative color?
Abhi, you're on the call. Sure. Abhi, you're on the call. Would you please answer this?
Yeah. So thanks for the question. See, I think the one is from a sustainability perspective. Of course, that's what our intent is. Why has the margin grown up so much? The quality of revenue has definitely improved. Our business in transportation sector, especially in the software embedded side, has shown very good improvement. So growth is one of the primary reasons I would say for this, and growth in the right areas and with higher, I would say, better quality of revenue.
So when we say better quality of revenue, if you could just give some color what that means.
Yeah. So our investments, like Amit said at the start, one of the big bets we have is on the EACV segment, which is electric vehicles, autonomous areas, and we clearly are seeing more growth in those areas, more wins in those areas, e-powertrain areas, and that helps. Of course, the investments we have made in the reusable solutions, the EV labs that we spoke of in earlier quarters, those are also helping us attract more customers and growth.
Thank you. The next question is from the line of Vibhor Singhal from Phillip Capital India Private Limited. Please go ahead.
Yeah, really, sir. Thanks for taking my question. So two questions from my side. So the first question that I wanted to take your opinion on is, if you look at our total revenue, we've now crossed that $200 million revenue quarterly run rate, which is where we were in Q2 FY20, so around 5 quarters back. So I mean, we basically the COVID led to a trough in the next couple in Q4 and Q1, and from there we've recovered a pretty much a V-shaped recovery. So just wanted to check that now that we are now back to those Q2 FY20 levels, are majority of our clients also back to their pre-COVID level spending for us, or is it that in the meantime we have gained new customers and new businesses, and many of the large clients are still much below their pre-COVID levels, and that basically backlog or that revenue is yet to be gained by us, which can be the potential growth area for the next couple of years or next few quarters maybe?
Sure. So number one, thank you so much. Right, and some of you, tracked us and been with us since we went IPO and prior as well, and we appreciate the confidence. Having said that, as you will recall, we touched close to $200 million in Q3 of FY20, right? And from there we declined, right, because of COVID in Q4 and then beyond, and then we've come back like you said, right? What has changed is two things. Number one is pre-COVID, and I'm going to get a little specific here, right? So and then I'll come to accounts as well. So pre-COVID, the amount of conversation on electric vehicles was not so much there, and autonomous, it was largely a lot of infotainment and autonomous, right? But post-COVID, we are seeing a lot more conversation, money being spent in electric, autonomous, and connected. Cyber security is another area that's added on in transportation. As an example, pre-COVID, there was not a lot of spend in medical in the areas of telemedicine or in home care, right? And those two areas are picking up speed as we speak now, post-COVID. Third, digital manufacturing was a conversation pre-COVID. Post-COVID, we are seeing money being spent in that. The point I'm trying to make is that the color of the dollar has definitely changed. The conversations have changed. Digital as well. And digital is a very broad word, so I don't want to go there. I'm an engineer, so I don't want to just say digital, but that's where it is. So color has changed. In fact, our Global Engineering Institute that we have set up, which Abhi, as well as people that he had hired, set up, has been instrumental in turning the color of even some of the talent that we have got. So that has been a change. So it's not like, go back to the same old, etc. Second, from a client standpoint, in our, if I look at our, 30 million run rate clients, or I look at my 20 million run rate clients, that has fairly been the same. Couple of them may have, dropped off for various reasons of, we had already told you that one of them had sold their 5G business, one of them had divested to a private equity, but we have seen a fair mix to be steady and grown with us. So somebody had asked the question, are clients getting deeper with you? The answer is true, the clients are getting deeper with us. Having said that, the word of caution, right, that I would definitely want to say, because look, we want to be honest and whatever we see, we want to tell you, right? What we don't know is, will wave 3 come back in a much bigger way, right? We are seeing hospitalizations down even though infections are up in Europe. Decision making is almost back to normal. But will this continue? There are some variables that nor do you have an answer for, nor do we. But we will continue to stay engaged and tell you. But I can tell you that your company for sure has seen a change in the type of work we are doing. And we are confident that we have the right talent and the processes in place to scale up in that area. Long answer. I hope I have addressed what you asked.
Yeah, pretty much, sir. I think that was quite comprehensive. Thank you so much for that. I just had one more question. You mentioned that in the plant engineering segment, we had a deal with an FMCG client for whom we designed the entire new plant with the most stringent of norms. So, to get a color on the segment, was that a one-off, or are we seeing FMCG companies setting up more and more plants across the world, and there are more conversations happening in that segment?
So there are two things that we are seeing, and I'll again break up the segments for you. So if I look at food and beverages, we are definitely seeing a trend of smaller plants coming up. So that means smaller capex coming up that are more regional, that are supplying to the demand in the region as opposed to mega plants. So that in food and beverages we are seeing. Right? Now, is this a trend that will hold? Is this a trend that will change? Don't know, but right now we are seeing that. Right? It was there in Asia. Just by the way, if you Google, it was there in Asia. It was not. There were mega plants in the US and Europe, while there used to be smaller plants in Asia. Now we are seeing smaller plants in US and Europe as well coming up, as opposed to mega plants. While we have one food and beverage, we are seeing that. I don't know how long that will continue. Second, what we are seeing is, in plant engineering, that oil and gas companies are coming back and talking to us about changing their fuel mix. So the output that they give will be less gasoline, will be more jet fuel, maybe more chemicals, etc. So there is brownfield upgrades and changes people are talking about. So I do believe that that is again different than what we saw about 4, 6, 8 quarters ago. So those are the two changes.
Thank you. The next question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Yeah. Am I audible? Hello?
Yes, sir, you are.
Yeah. So thank you for taking my question and congratulations on a good set of numbers. So while we have seen a addition in the headcount during the quarter, the sales and support headcount has fallen from Q4 to Q1. So if you could shed some light on that, and Related question to that was that will this see a reversal in the upcoming quarters if we have to see that growth surpassing the 20% mark going ahead? Thank you.
So I'm going to request Rajiv to take that, but on a principle basis, I want to tell you that it's not like we fired salespeople or support just because the revenues went down. We haven't skimped on that, but we've optimized for sure. But I'm going to request Rajiv to take this question.
Sure, Amit. Mayank, to respond to your question, I mean, we continue to invest in our sales organization. When you look at sales and support, it's not that it has taken a big drop, right? This is just part of the thinking ahead in terms of how do we, work more effectively. So to put it in a short context, we continue to invest in sales because we see the opportunity, right? With the kind of demand, we'd like to see investing into sales functions so that we can see further growth coming in newer and newer accounts and also being able to expand on our current set of accounts. It is just that we are trying to manage this more effectively, more on the enabling side.
Sure. Thank you and good luck for the rest of the year.
Thank you. The next question is from the line of Udit Methi from Stanley and Lamont Group. Please go ahead.
Hey, can you hear me, guys?
Yes, sir, we can.
Yeah.
Yeah. So I just wanted to ask, during your performance highlights, I could see that an American automotive has selected LTTS as strategic partner for their EV and power electronics product. So I just wanted to understand that due to this lack of supply for semiconductors and things like that, are you guys planning to ramp up your production for this? Because I see that this is a big opportunity that we could, jump on. And do you plan on any capex expenditure in terms of power electronics?
Okay. So number one, to answer your question, we do not do manufacturing, right? We are largely focused on design, sustenance, engineering, right? So therefore, the chip shortage is not impacting us per se, right? If anything, design cycles are where they were, etc. So we don't see that. Do we see overall an opportunity with chips and FPGA and the likes in the automotive sector? Absolutely, yes. And we are continuing to hire, build, train, cross-train, all of those to positively take advantage. In fact, our whole strategy around multi-vertical strategy is paying out well for us because we are able to leverage getting semicon design wins in automotive, etc., on and on and on. So that's definitely there, right? And can you repeat your second question?
Oh, that was the only question I had. That's all. Thank you.
Thank you. The next question is from the line of Pritesh Vora from Mission Holdings. Please go ahead.
Hello, sir. Can you hear me? Sir, hello?
Yes,
can
sir,
you hear me?
You may go ahead.
Amit, you have highlighted that U.S. government is investing in infrared investment. What do you see impact in which of the vertical this will play out over next 5 or next decade? And second question is how private investment climate shaping up in USA?
Participants, please stay connected. Line for the management got dropped. Ladies and gentlemen, please stay connected while we rejoin Mr. Amit back to the call. Ladies and gentlemen, please stay connected while we rejoin Mr. Amit back to the call. Participants, please stay connected while we rejoin Mr. Amit back to the call. Ladies and gentlemen, thank you for your patience. We have line from Mr. Amit reconnected. Pritesh,
Sorry.
repeat your question once again from Mr. Amit.
Yeah, so I will repeat the question. Amit, you highlighted USA government infra-led investment in some of the areas. What do you see impact of this infra-led investment by US in next 10 years? In which of the vertical it will play out for us? And second question is how private investment climate is shaping up in USA?
So first of all, I apologize. The line had got cut. This time around, other than mobile, I had asked them to connect me on landline. So as you can see, mobile is more effective than landline. So we'll keep this as a lesson for the future. But I said that, so thank you so much. Again, apologize. Now, if I go back to the spending, see the US government talked about, and last time I had covered that, they talked about infra spending, right? That will impact us in the areas of trucks and of highway for sure, because companies like Caterpillar, John Deere, others will benefit from that. Second, as infra improves, automotive itself will benefit. Third, because of green energy, electric vehicles, etc., we expect that to continue to grow. So that's space number one. Number two is because of climate, green energy, etc., people are talking about this whole industrial product sector that we have got, digital manufacturing as well as sustainability are three areas that will see an upswing in terms of spend and attract investments, etc. If somebody is interested, you can actually see that the number of wind turbines on the shores of the US is going to go up drastically. And interestingly, the problem is not that wind turbines cannot come to the US. It's also because there is a shipping law that requires ship to be of a certain type or owned by certain people that can only bring the submarines into the sea. I mean, it was very interesting when I read about it. And so the whole ships are being built to try and transport it. So very interesting, whole ecosystem coming up. So I do believe that will help for sure. Third, I do see spending in private sector changing with the chemical, actually you can go Google it. Exxon has talked about it. Look at the fuel mix that they are saying will happen in 2030 coming out of the refineries as opposed to what's coming out today. There is a huge change in that will require refineries to be changed, and I believe that is a spending area. Fourth is the recent act that the US passed called the Innovation and Competition Act. It's a $270 billion plan, which is part of it is Chips for America Fund. There is Technology Directorate getting money. There is Department of Energy getting money. There is a competition around digital connectivity, cybersecurity. So we may directly not get revenue from it, but my belief is that will build an entire ecosystem, and we will be participative in this ecosystem and will help us. Finally, one thing not going away, which is US, Europe, in fact India as well, is that, and I'm going to say this because a lot of my colleagues from finance and others on the call, I often say that people that could afford to buy a Montblanc pen 5 years ago will definitely spend money on a small blood pressure monitor 5 years from now. So you will see home healthcare definitely go up. So I believe that there is avenues, opportunity. Now, what is to be seen is what is the pace of that's going to come out, how much of it companies will do themselves, how much of that will be coming to people like us, will we be able to ramp up to be able to build that capability, do we have reusable assets, a lot of that going on. A long answer, but that's how I see it.
Thank you very much, sir. All the best.
Thank you very much. I now hand the conference over to Mr. Pinku Papan for closing comments.
Thank you everyone for joining us on the call today. We hope we have been able to answer most of your questions. If you have any follow-up queries, please write to me an email. Also, I look forward to hosting all of you on our Investor Analyst Day coming in September. We will communicate the details very shortly. Thank you again. Have a good day and wish you safe times.
Thank you. Thank you so much.
Thank you very much. On behalf of L&T Technology Services Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.